Hello, everyone. So let us now continue with the fourth session of our revision, wherein we are going to take up the remaining topics which are pending with respect to all the initial parts of the audit and assurance syllabus, which talks about the framework, the rules and regulation, code of ethics, all of those which are very basic elements that we had studied in the syllabus when we did the beginning part of it. That means the first 4 chapters of audit when we started, we had taken up this particular chapter. All right. Now, as I told you, in the sequence we have already completed risk assessment, planning, evidence. Then we also spoke about internal control, where we understood about what are systems and controls and what is the responsibility of the auditor with respect to controls. And also we understood about the concept of internal audit, which is bought by the client in its organization. Okay, what is its role, what are the limitations, everything we have understood. Also, if the external auditor can use the work of the internal auditor or not. Okay, then. Yesterday's session, we spoke about completion and review, where we spoke about at the end of the audit, after completing a substantive procedures also, can we say this is the end of the audit, or is there going to be something more which the auditor is required to do? And that is considered to be the review part, that is, or we can say the last leg of the audit, where there are some more aspects to be checked, like subsequent events, the going concern assumption, we perform analytical procedures, evaluate the uncorrected misstatements, communicate some matters with TCWG. So there are n number of matters that we do at the end before we actually prepare the audit report. And then we also understood how the audit report is prepared by giving the reference to ISA 700 series, where we spoke about 700, 701, 705, 706, and also we spoke about 720. So basically, we have understood in a broader framework of how audit actually happens. Now, the core part of the auditing part we have already understood, from the planning to the reporting stage. Now we'll take up all the basic parts of the auditing syllabus, which was there when we began the discussion of the subject. When we started audit and assurance as a subject, these were the initial topics that we took up, where we understood a lot of very basic elements, like we understood what are assurance engagement, where we discussed about what is external audit, what do you mean by limited review. Then we understood regarding the corporate governance, some rules and regulations which are commonly applicable throughout the world. So we have taken on by and large, we have taken a regular framework, the principles of appointment of the auditor, removal of the auditor, resignation by the auditor. Then finally, we also spoke about the code of ethics, which was the major discussion that we had during the sessions we took our classes, where we spoke about threats, and we understood about what kind of threats could be impacting the independence. We understood about how safeguards could be taken, in which cases safeguards cannot be taken and we have to withdraw from the engagement. Okay. And then we also spoke about the engagement letter. So on a very broader framework, we are now going to take up the last set of topics that are remaining as a part of our discussion, which is nothing but the overall framework and the code of ethics. So let us get started with the discussion of the basic chapters of audit and assurance syllabus. All right, so I'm sharing the screen with you. Okay, let us begin with the discussion. So today's session, the approach will be a little different, because we are going to concentrate more on the study material than doing the concepts from the PDF that I have prepared. So basically, we are going to only look into the basic elements from this particular document which I have. And then we are going to study the main material here. We are going to refer the study material for major concepts. Okay. So this is the fourth level of our topics that we are going to take up, which talks about the audit framework and regulation, where we are going to study about the concept of audit and the other assurance engagements, what are external audits, the concept of corporate governance, and then professional ethics and ACCA's code of ethics and conduct. Okay. So these are the 4 chapters that we have as a part of study material, where all of these points are covered as a part of introduction to assurance, rules and regulation, corporate governance, ethics and acceptance. Okay. So basically these are the chapter 1, 2, 3 and 4 of the study material. Okay. So let us begin with the first one, that is introduction to the assurance topic. Okay. Now, first of all, what is the meaning of the word assurance? It's very simple. Assurance engagements are those where you will be having a practitioner. So there are parties involved. There is going to be a practitioner. There is going to be a subject matter which is going to be prepared. This subject matter has to be prepared as per a particular criteria. And the people responsible to prepare these particular subject matter is going to be considered as a responsible party. The practitioner's duty will be to ensure whether the subject matter is actually meeting the criteria or not. Okay. And if it is meeting or it is not meeting, the understanding of that you will get by obtaining sufficient appropriate audit evidences, and the conclusion that you draw, you give in the form of written report. Okay. So basically, there are 5 elements to the assurance engagement, which talks about the auditor, that is the practitioner, is required to obtain sufficient appropriate audit evidences to draw reasonable conclusion that whatever subject matter they are going to review, it is actually meeting the criteria or not. Okay. So here we can take the example of the practitioner being the auditor. Subject matter could be the financial statements. Criteria is financial reporting framework. So the auditor, and who will prepare the financial statements, it is prepared by the management, that is the directors and all of them. So they'll approve it. So here you are saying that the auditor is going to review whether the subject matter, that is financial statement, is prepared as per the applicable financial reporting framework. This he will do by obtaining sufficient appropriate audit evidences, and basically this report he will give in the form of writing, that is, he's going to come up with a written report which is going to talk about the assurance that he is going to give on the financial statements. Okay, so there are 5 elements. It talks about practitioner, it talks about the subject matter, it talks about the responsible party, it talks about the intended users, it will talk about the criteria. Finally, the auditor has to obtain sufficient appropriate audit evidences, and whatever opinion he draws, he gives in the form of a written report. Okay, so that is the basic understanding. Then you have the types of assurance. One is the reasonable assurance, other is limited assurance. Reasonable assurance you can take in at a very large understanding of external audits, where the auditor's opinion, where multiple people are going to rely on it, where he is required to obtain sufficient appropriate audit evidences, and he's going to give an opinion on the financial statement on which the stakeholders are going to place reliance upon. Okay, but whereas limited assurance, okay, here the auditor is going to give an understanding that we give a true and fair view, that the financial statements are prepared as per the applicable financial reporting framework. So it's going to give a reasonable assurance, and reasonable assurance will be obtaining only after obtaining sufficient appropriate audit evidences. But in limited assurance, we are not going to have in detail the sufficient appropriate audit evidences obtained. There is going to be a limited review conducted, and the reporting here will be in a negative manner. So basically, one simple example here could be where, suppose if the management requires to obtain a loan from the bank, then the bank will ask you to provide the audited report, or maybe the audit to be performed for a limited purpose of obtaining the bank loan. So it could be for a quarterly period, for semi-annually, where very limited data will be available. Based on the data available, the auditor will perform the review, and it is going to be in a very limited manner. So this is considered to be what? A limited assurance, where for a particular specific reason, the review will be performed. And here, the way in which the report will be prepared is in a very negative way. It is saying that, according to us, we have not come across anything that would cause the financial statements to be materially misstated. Here we give a very positive answer. Here we give a negative impact. Okay. External audit engagements are those where the auditor is going to give opinion on which the financial statements, where end users, stakeholders are going to rely on that particular opinion. Okay. Review engagement are basically done voluntarily. Okay. Okay. And it is going to be for a limited purpose, for serving a particular reason. These particular review will be conducted. Okay. External audit. Okay. These are usually mandatory by law. So especially in the case of companies and all, they become mandatory. Okay. However, let us now quickly go through the study material, and we'll pick up all these topics quickly so that you'll have a recapturing of everything. We will not spend much time on again recapturing everything. I would rather focus more on the questions today so that you'll be able to get an understanding of the kind of questions that we can expect from this particular topic. Okay. So we'll focus more time on the questions rather than reading the content, which is now self-explanatory. So if you've actually gone through the material, if you have listened to the lectures even once, all of these things will be quite clear to you. Okay. So let's have a quick reading from the study material. Okay. So what is assurance? I told you there are 3 parties involved. There is going to be practitioner, intended user, responsible party. So responsible party in my example were the people who are going to prepare the financial statement. So it is going to be the management. Intended users could be all the stakeholders. Practitioner is the reviewer. Okay, the auditor in my example. Appropriate subject matter is going to be the financial statements. Suitable criteria is as per the applicable financial reporting framework. That is nothing but the standards, the guidance, everything issued, laws and regulations. Then how the review will be performed, the auditor has to obtain sufficient appropriate audit evidences on which he is going to draw his opinion. And finally, he will give in the form of a written assurance report. Okay, so that is the meaning of the word assurance. Okay, then in relation to audit, audit is going to be what? A reasonable assurance. In relation to forecast, forecast is a budget. And budgeting, we don't have all sufficient evidences. So that is going to be a limited review. Okay. Then we'll not read this. Instead, we'll go of understanding what is the difference between a limited review and a reasonable assurance. That will be much better or much useful as of now. Okay. So let us take the types of assurance engagements. In assurance engagement, you'll have two types. One is reasonable assurance engagement. Other is going to be limited assurance engagement. In reasonable, what is the understanding? You are going to obtain sufficient appropriate audit evidences in order to obtain reasonable conclusion. Here you gather the sufficient appropriate evidences, but only to draw limited conclusion. Here very thorough procedures are performed. Here very fewer procedures will be performed. Here you have to check whether financial statements are conforming in all material respect as per the FRF. That is, subject matter should conform with the suitable criteria in every respect. Here what we do, we conclude that the subject matter with all respect like there is a plausible circumstances, you have to identify whether everything is matching or not. Here every item we are not going to pick up, but whatever information is available, that we are going to check and tell whether yes, it is matching or not, or is it as per the financial reporting framework or not. Give a positive worded opinion. I told you, we give a true and fair view is what we say. You're negatively worded. You're very important. High level of assurance is there. You're moderate or low level. Okay, it is a limited assurance. You'll not get a high level of assurance. Most important part is here where we look into the way in which opinion is given. How opinion will be given? The financial statement give a true and fair view. So it's a very positive way. But here we say nothing has come to our attention that causes us to believe that the financial statements are not prepared in all respects in accordance with applicable financial reporting framework. So the way in which the opinion is drafted, that only will be in a very negative way. Here it is positive. We are telling it gives a true and fair view. Here we are saying we have not come across anything which is telling we are reporting a no true and fair view. Okay, so both are telling it is correct. But one is giving in a very negative manner, one is giving in positive. But all the standards on auditing, all the laws and regulations, or the major responsibility of the reviewer is going to be on reasonable assurance. So basically all the professional standards, the international auditing standards, the laws and regulations, all that we come across, they will be mainly for which one? It will be for the reasonable assurance. For limited assurance, we don't have those many standards. Okay, then. External audit engagements are the classic example for reasonable assurance, which are going to enhance the degree of confidence on the intended users. We talk about giving a true and fair view, or in the case of compliance framework, that they are complying in all material respects in accordance with the applicable financial reporting framework. Okay, the audit will be done as per the international standards on auditing. So true is factual, fair is going to be clear, impartial, unbiased. So these are all the words that we have taken in detailed discussion. Okay, then what is the objective of the auditor? Very clearly, obtain reasonable assurance, express opinion, and finally prepare the audit report. Okay, an audit report, we know we have all the standards in series of 700, so it has to be prepared as per the ISAs. Okay, the why need of external audit, very simple. The monies of the shareholders, the managers, are the directors. So in order to bring a good corporate governance, in order to understand that the money is used in the right direction, or there is no manipulation of the accounts, there is no fraud happening, you are required to have an audit conducted, because of which, the shareholders being the owners and the directors being, the managers, there is a separation of ownership and control. So audit plays a very important role in this particular area. Okay, an independent review is mandatory. What is the benefit of having an audit conducted? Okay, higher quality of information, which is more reliable. Obviously, whenever some external party is going to review, the credibility of the financial statement will be enhanced. Independent scrutiny, it is a third party completely independent who is doing the scrutiny. Okay, so there's not going to be some kind of biasness involved. Reduces the risk of management bias. See, we cannot say it is going to eliminate, but yes, it is going to reduce. Enhances the credibility of the financial statement, so the tax authorities will more trust on the audited financial statements, and the bankers also will trust on audited financial statements only. Then deficiency in the internal controls also may be highlighted by the auditor, that we have seen, okay, as per the reporting that we have learned, we have understood the communication which the auditor does to TCWG management, where even deficiencies which are identified will also get highlighted by the auditor. Okay, so these are very important parts that we need to understand why audit is conducted. Okay, then what is expectation gap? Usually we see that people who do not have the proper understanding of what the audit is, basically people who don't come from the non-commerce background, they will not be understanding the exact meaning of the word audit. So they will think when audit is conducted, that means there is no misstatement only. When audit is conducted, all the transactions are correct. Okay, so basically that is the way in which no misconception is created, and that misconception is considered to be expectation gap. So what is audit and what people perceive audit to be are two different concepts. So that is called as the expectation gap. So what examples could be for expectation? That the auditor will do the testing of all transactions. Wrong. Auditor do not have all the time on earth to test all the transaction. So we do sampling. Correct? We are not obtaining absolute assurance. We are obtaining reasonable assurance. And most importantly, it is believed that the auditor will be responsible for the preparation of the financial statement. But now you, as you have gone through the course of the auditing syllabus, you know it is the management who is going to prepare the financial statement, the directors who are going to approve the financial statement, and auditor is going to only do the audit. Correct? So basically, preparation is not the responsibility of the auditor. But the myth or the people's belief is that auditor will prepare, auditor is going to check all the transaction. Once audit is done, that means no misstatement absolutely. So that is considered to be an expectation gap. Now, we always say audit will give an reasonable assurance and not absolute assurance. Why? Because these are the reasons. A lot of estimates are involved. Okay, the way in which the reporting is done, financial reporting, is that there are many places where purely management judgment is involved. Like depreciation is there, you have estimates like provisions and all are there, where it is purely the assumption of the management, where what is right, what is wrong, you cannot understand. So obviously, absolute assurance, not possible. Internal controls will also have their own inherent limitation, so you cannot thoroughly rely on that. Representation of the management, you have to rely on at some places, and how can you believe it is going to be 100% correct? Evidences are more of persuasive in nature than conclusive. As I told you, it is our investigation. So we don't get more of conclusive, we get more of persuasive. And basically, we do the audit based on sampling. So all the transactions are not checked. So obviously, we'll be able to only obtain reasonable assurance and not absolute assurance, because we cannot do 100% of the checking. Okay. So that is the reason, that is the limitation of the audit. And also understand, we have to finish the audit in the given time frame. So there is a limitation on the time and the cost involved, because of which that also is the reason why we'll be only able to obtain a reasonable assurance and not absolute assurance. Correct? Then review engagement. Review engagements, as I told you, they'll be done voluntarily for a specific purpose. Okay, so review engagement is done voluntarily. You perform analytical procedures, you make some inquiry, and basically you give what kind of report? A negative report will be given. So whenever the banker will ask you to perform the limited review, or for a particular reason you require it to be performing, then in that case you go for limited review, where because you have a objective to perform, you get this done. It is not required by law. And in the limited review, testing of controls and all that will not happen. Basically, you directly have the substantive checking done. Okay. Inquiry, analytical procedures. These are the common things that we go on with respect to limited review. Okay. Then, and obviously we give a negative assurance. Then, incorporation and separation of ownership and control. This is more of legal perspective. In companies, we know control is with the directors, whereas the ownership is with the shareholders. There is a difference between both of them, and that is the main reason why audit is conducted. So shareholder will seek to maximize their wealth. Directors want their payment to increase. So basically, both have their own interest here. So it is very important you have an independent third party reviewing whether things have been properly reported or not, because there is a conflict of interest here. Okay. Then what is accountability? Directors will be responsible for using the money in the right direction. Okay, and agency means obviously directors are working for the company. So it can sound that directors are the agent, but it is not like that. Directors are actually standing in the stewardship relationship, that is fiduciary relationship. They're acting in good faith for the favor of the company. Okay, so it is basically the relationship we consider it to be stewardship. Stewardship is the responsibility to take good care of the resources. Okay. So thus this relationship where one person has a duty of taking care towards someone else's property, we call it to be fiduciary relationship. So the final conclusion here is directors are stewards of the company. The shareholder is the principal, employing the directors on their behalf. Directors are accountable to the shareholders for the way in which they run the company. This is quite acceptable. Okay. This is quite understandable also, no much discussion required, because as per the legal framework of companies only you know who are the owners and who are the managers. Okay, so this is the basic discussion that we have regarding the first topic, which is very, very simple regarding introduction of assurance. But there are two important aspects you need to take home. One is that regarding what is reasonable assurance. Second is what is a limited assurance. Okay, all right. Moving to the next one, we will now talk about the next topic, which is going to be rules and regulations. Now, this rules and regulation, they have not given about a particular country, or they have not spoken about, in detail, they have not spoken about how the auditor has to be appointed, how resignation can happen, how he can be removed and all of that. Because every country, you talk about India, you talk about UK, you talk about any country for that matter, every country has their own rules and regulations governing this methodology of what are the rules and regulations of appointment, removal and everything. So basically, as a part of your syllabus, they have given you a broader principle which is applicable throughout the world. So basically, they are telling you about how what are the principles which have been adopted for the purpose of appointment, removal, resignation, etc. So it is not inclined to a particular kind of company or country, or they're not picking up a particular country, or they're not talking about every single country. Otherwise, it is going to be it's going to be not exhaustive. It is going to be like going on and on and on. So that is going to not make any sense to any of us. And that is the reason in the topic of rules and regulation, they have only spoken about the principles which are commonly adopted by all the countries for the purpose of appointment, removal, okay, resignation of the auditors, etc. Okay. So this particular topic is in a very generalized approach. It is not having a kind of a specific approach for a specific country or a specific rule, specific regulation. No. It is talking about the general principles accepted for the purpose of appointment and removals. Okay, so let's have a discussion. So now this is the topic of rules and regulations, where you can see what is the need for having rules and regulation, just to bring harmonization. If we don't understand what should be a proper rule and regulation, then any country will follow anything. There will not be anything called as harmonization, and everybody will be at a freedom to have any rules and regulations in place. The audit quality will get compromised. So if you have something which is an expectation of the general public with regard to the reviewers, then in that case, to maintain the quality, there has to be a standardized policies to be followed. And obviously, ethical code is applicable. So in order to adhere with the ethical code, there has to be common practices which should be prevailing. And because of this, you have a need to have all rules and regulations in place. Okay. So in order to achieve this, practitioners have to follow regulatory guidelines. First of all, you have the National Company Law. This is with regard to Companies Act 2006 in UK and Sarbanes-Oxley Act in US. Then you have auditing standards and then code of ethics. These all are telling that, yes, because of all these in place, there is standardization, harmonization of how, practices are required to work on. Okay. Legal requirements for audit and auditors. So basically, which company is required to get audit done. Okay. Where it has been made mandatory. Then in that case, you'll also be able to understand regarding who can or who cannot carry out the audit. Which companies are required to have the audit done. Who can and who cannot carry out the audit. How is auditor appointed, resignation, removal of the auditor? What are the rights and duties of the auditor? So very generalized discussion has been happening about who can and who cannot. Okay. Who needs an audit and why? Basically, if you look at a country like India, it has been mandatory for the companies to have an audit done. Similarly, in some other countries, even if it is a company, there are some criteria with which they can seek exemption for getting themselves audited. But understand it is for the greater interest. Okay, that the companies have to get themselves audited because there is going to be separation of ownership and control. So for a quick understanding, in most countries, company audit is required by law, so it is mandatory. Small owner-managed companies like OPCs and all, they're often exempt. This is because there is less value in the audit of these companies. Note that these exemptions often do not apply to companies in certain regulated sectors, like financial services, bank and all, listed companies and all. Even if you're small, does not matter because you're regulated by stock exchanges, SEBI and all in India. So in that case, however small you are, audit will become mandatory. Okay. Who may act as an auditor? The member of the RSB, that is the recognized regulatory body or supervisory body. Like in India, we have ICAI. Okay. In the broader framework, we have ACCA. Okay. According to their guidelines, who is eligible to be appointed as the auditor, he can. Sometimes the government will appoint the auditors in requirement of government audit, when the audit is required by law. Okay. Or the audit is audited by the state. Then in that case, it is also the government who is going to appoint. So when you talk about state, you mean the government. Then conducting of the audit work, who can do it? Sole practitioners, partners, LLP and directors of an audit company. But understand in India, if you talk about in precise, sole practitioners can, partners can, LLP can. But company cannot do the audit. In India, we have a ban or we have a disqualification of the body corporates to perform the audit except for LLP. So in this case, here we say the audit company. If you talk about in India, it is not allowed. But if you talk about a country like UK, okay, their audit companies can be formed, but directors can go and do the audit. Okay. But in India, we don't have this criteria. Okay. Then in case of companies, obviously authorized people will be there who will be allowed. Who may act as an auditor? Excluded by law. The law in most countries exclude who manage or work for the company, that is employees, or those who have business or personal connections with them for auditing. So all this is looking care of independence. So if you are the employee of the company, how can you be the auditor? If you have personal connections with or business connections with an entity, how can you become the auditor? You'll have your own interest. Similarly, code of ethics also will talk about certain guidelines, which if you like looking into matter of independence, competence and all, keeping into mind, you have to be very careful who can be appointed as the auditor and who cannot be appointed as the auditor. Then who appoints the auditors? Obviously, in the case of companies, the shareholders prima facie. Directors will be able to appoint if suppose auditor is appointed by the members, but if this auditor appointed by the member dies or resigns, which called as casual vacancy, and if casual vacancy arises in the course of the auditor or in the position of the auditor, it is filled by the director. And as I told you, many a times we see even the government is going to appoint the auditors. In that case, the secretary of the state will do the appointment of the auditors. And also, if suppose if in the AGM the auditor is not appointed and the directors also do not appoint the auditor as and when required, then if this gap of the auditor or the position of the auditor is not filled up within the given time frame, then the state will take the control and they will fill up the gap. Okay. Then removal of the auditor, obviously people who appoint only can remove. So you will be requiring very importantly the permission of the shareholders coming up. And obviously before removing the auditor, he should be given a reasonable opportunity of being heard. The auditor has a sufficiently secure tenure to maintain independence of the management. Okay, the auditor can be removed if there are doubts about the continuing ability to carry on the audits effectively. Removal of the auditor can usually achieve by simply majority at the general meeting. I told you shareholders only have to remove. There are some safeguards such as specific notice period has to be given to him. Then resolution has to be passed. Also, I told you that you should look into influence of the outcome. That is, shareholders only will decide at the end, can you remove the auditor or not? And auditor will have the right to make a representation where he's trying to defend himself. This representation should go to all the members and it should also be allowed to be read at the meetings so that people know about what representation he's making. Okay. Then, whenever you're removing him, information has to be given to the regulatory bodies as well. Okay. Can the auditor also be resigning? Yes, possible. Auditor can also resign. So in that case, it is important for the auditor to give a written resignation letter to the management and the regulatory bodies. Okay. Also, it is important to notify to ACCA. So the Association of Chartered Certified Accountants, to them also, it is important that you give the intimation of the resignation or removal. If an auditor resigns or is removed from the office before the end of their term, they must notify to whom? ACCA. Okay. Then auditor's rights, he'll have access to all the information, all the explanation. Okay. Whatever he requires information from the management, from any of the employees, he can raise any question and they are having the obligation to actually give answer to them. When the general meeting is conducted, auditor has the right to receive the notice of the general meeting. He can also attend the general meeting. He can also speak in the general meeting for the matters which concern him as the auditor. Written resolution copies he can receive. Okay. Then in the case of resignation, okay, on resignation to request a general meeting of the company to explain circumstances of the resignation, to require the company to circulate the notice of circumstances relating to resignation. So he wants the people to know about why he resigned. So he will get all the rights to let the people know in the general meeting about the reason for his resignation. What is the duty of the auditor? Primary duty is to obtain reasonable assurance that the financial statements are free from material misstatement. Okay, obviously you will have some other reporting responsibility. Like in India, we have the company law. So if you have the company law asking them to report something extra, then in that case, that also will be the reporting responsibility of the auditor. Then international regulations, we talk about IFAC and ISAs. This you can have a quick reading by at your end. Okay. Here only one kind of situation is given where, all the countries are trying to they're trying to get in line with all the international standards, because of which there is going to be a harmonization with the rules and regulations. Okay. So this is the topic with regard to rules and regulations. Then we have corporate governance. Now, in the case of corporate governance, this topic is very big. Okay, not very big as such, but it is talking about the meaning of corporate governance. So it talks about that people who are running the business, they are very much accountable to the stakeholders. Okay, so it is very important that is what is happening in the company. The other people are aware of it. They should be working for the benefit of the stakeholders. There has to be a transparency, because of which there is a good corporate governance, which is very important to be operated in the organization. This good corporate governance can be understood by the way in which the corporate structure is, the way in which the board of directors are formed, what is the composition of the board of directors, what kind of directors do you have on the board, whether all are executive, do you have non-executive directors, independent directors are there or not there. Then how the audit committee is formed? Does the company really have an audit committee? Because if the audit committee is there, the governance would be even better. Okay. Then because they're more independent, have more number of NEDs, which will help in functioning better. The nomination remuneration committee will be there, which will help in the proper appointment and the remuneration of the officers and the employees, where unnecessary funds will not be wasted for the purpose of paying them extra. So there'll be a good transparency, there'll be a proper utilization of the resources at the viewpoint of the company. So basically, this topic talks more about the way in which the company requires to operate so that they give an effective value to the people, okay, who are the actual stakeholders of the company. Okay. So this topic will have only the proper reading of the heading, and at some places I'll make you understand the concept. Okay. Otherwise, it is just a reading that you require to have properly so that you understand which will call a particular, like for example, if we discuss about audit committee, What is audit committee? We need to understand, but how the structure should be, what is recommended, okay, what is not acceptable, all of that is given in detail. Okay, so that you can do a line by line reading at your end also. Okay, so let us have a quick glance with what is the discussion of this entire topic. Okay, so in corporate governance, basically we understood the importance of the corporate governance, and what is the importance is that the aim of corporate governance is to ensure that the companies are run well in the interest of their shareholders, employees, and other key stakeholders, such as the wider community. Because here the ownership is different, management is going to be different. So whatever they do inside, it should be beneficial for all the stakeholders. The aim is to try and prevent company directors from abusing their powers, which may adversely affect the stakeholder. So they could try to, do some kind of manipulation, try to fill their pockets, because of which at the end the stakeholders will lose money and all. So that kind of thing should not happen. And because there were a lot of scandals seen in the world, like regarding Enron or maybe Satyam and all, where we saw that the stakeholders actually at the end lost the money, because of which the importance of corporate governance has been there. So every company actually has the best practices to be followed for the purpose of corporate governance, because it provides for greater transparency, greater accountability, so directors will be responsible now, efficiency of the operation for the optimum utilization of resources, better able to respond to the risk. So your proper committees designed, okay, so that they're operating for the purpose to identify the potential risk. Then less likely that the company is getting mismanaged, because you have one after the other reporting element present in the organization. The very rare chance that there could be mismanagement, because at every level you're going to report to the higher levels, which are going to be independent people. So mismanagement chance is going to be very less. Okay. Now, corporate governance code, here they have spoken about the UK code, okay, which talks about the 6 OECD. Basically, these are applicable for all the companies. Okay, so throughout the world nowadays, people are keeping these principles in their mind and framing their corporate governance structure. So what are they? Ensure the basis for effective corporate governance framework. That means the Organization of Economic Cooperation and Development, OECD, has given 6 principles, okay, for the policymakers to draft a good corporate governance policy. So first, you have a good framework. Right and equitable treatment of the shareholders and the key ownership functions. Institutional investors, stock market, other intermediaries for them. Role of the stakeholders. Disclosure and transparency, and the responsibility of the board. So they have set out proper principles with regard to all of these. And if you really follow them properly, then there is going to be a good corporate governance practice that you're following is what is assumed. Okay. So this code is split up into 5 parts: board leadership and company purpose, division of responsibility, then composition, succession, and evaluation, audit, risk, and internal control. Here basically you talk about the audit committee. Remuneration, we have the nomination and remuneration committee. Okay, you might definitely feel now that it is going a little faster, but trust me, when you actually go through the syllabus discussion, this we have picked up very slowly, very exhaustively, and it has been done in detail. Okay, the focus today is basically I want to concentrate on the question bank, because as part of revision, I believe that is more important. Okay, but yes, I want you to go through quickly through all of this, what is available, so that you have a glance of what is covered for you. Then board leadership and company purpose, you have told that who is responsible to take the leadership, that is with regard to all the implementation, designing, monitoring and all. It is the the board of directors. They will be responsible for it. Now, what is the board's role here? So in the board, you have the chair, you have the chief executive, you have executive and non-executive. So if you look at the composition, they're telling there is going to be a chairman, CEOs are there, that is chief executives are there, executive directors are there who will take in the regular participation, and non-executive would not participate on regular basis, but they provide their expertise or advice to whom you give the sitting fees. So chairperson is basically responsible for the flow of information, satisfactory channels of communication, effective operation of the subcommittees, okay, to ensure the effectiveness. Okay, then chief executives are basically responsible for all the operations of the company. They are the head of the executive officers, directors. Then for the running on the company day-to-day basis, we have executive directors. Non-executive do not attend the companies regularly, but they provide the expertise advice. They help in the formulation of the overall strategy. So they meet as and when the meetings are conducted, for which they'll be paid the sitting fees. Okay, so they won't part in the routine. They don't take part in the routine development. Okay, they participate at the board meeting. They bring their experience and expertise. Okay, and they sit on the subcommittee, like for example, audit committee, nomination, remuneration committee. These kind of subcommittees, they be a part. Okay, because they play a very important role there. Then advantages, disadvantages are simple. Division of responsibility, obviously, chair, board of directors, NEDs, EDs will have all set of responsibilities. Reason being, if one person is given all the responsibility, corporate governance structure will fail. Okay, so your proper understanding is given as how division of responsibility will happen. Then you have composition, how the board is composed, how will the succession be, and how evaluation will be done. So obviously you'll have the audit committee doing the evaluation of the board of directors. Okay, board of directors, how they're functioning. Okay, all of that. The audit committee also will do the reporting to the board of directors. Whether NEDs are really, NEDs will do the evaluation of the board at large. So there are a lot of things that we have already discussed here, where you'll be understanding regarding the evaluation process, whether board is actually performing the duty correctly or not. Then you have the nomination committee. Basically, they are responsible for the nomination of the executives, directors, okay, members in the audit committee, all of those. Okay, then audit risk, internal control, including audit committee. Here we have more of roles of the NEDs. We require non-executive directors, the independent directors to be participating here because they are more competitive, they are more independent. So it is very important that the majority in this audit committees should be of that of the NEDs. Okay, because audit committee plays a very important role with regard to checking of the compliances with all the internal control implementation, to check for the adequate financial reporting, whether financial reporting has been done adequately or not. Okay, all of this, they provide the advice for proper reporting and all of that. Okay, yeah, this particular part is very important because you can have a question also on this. In the annual report should describe the work of the audit committee. So what all is the work of the audit committee which is described in the annual report? Significant issues considered relating to financial statements. So whatever issues identified in the financial statements which are addressed by the audit committee, that comes in the annual report. How you have assessed the independence and the effectiveness of the external audit process. Where there is no internal audit function, the explanation for the absence and how the internal assurance is achieved. An explanation of how auditor's independence and objectivity are safeguarded. So basically in the annual report regarding the audit committee, these matters have been explained. So that's very simple. Then you have audit committee. We can have this chart reading, and chart reading will be helping you quite better to understand. First of all, composition. Audit committee also will require minimum of 3 non-executive and 1 should be from the financial executive because it is audit committee. It is concerned with the financial statements. What is the objective? Increase the public confidence, financial awareness of the non-executives, and lessen with the external auditor. It's a communication, the gap which is there between the external auditors and that of the management, that gap will be bridged by the audit committee. So there'll be like a mediators in between. What is the function with respect to the financial statements, controls, monitoring, supervising, all of that. Internal audit department will be reporting to audit committee, and there'll be a liaison between the external auditors. Also, whistleblowing, very important, is a part. Any person who has to give any information, they will go and directly intimate to whom? The audit committee. So they will also take the whistleblowing information, that is, people who have some kind of grievances which they want to secretly inform, they can directly approach the audit committee. Okay, objective of the audit committee is basically the same thing: credibility of the financial statement, internal control, overviewing. Okay, all of that. So in this entire topic, if you can go through with complete patience, and when you really actually go through it line by line, which you've already taken in the entire subject, okay, topic wise, then you will see that I've picked up all of these and we have done a detailed discussion where you'll understand what will be the role of audit committee, what is the composition of audit committee, what is nomination remuneration committee, what is the role of the nomination remuneration committee, what are the advantages, what are the disadvantages, all of that. So remuneration, you can see you have nomination remuneration committee where NEDs will be again a very important role. Okay, it should not be that the auditors, the directors, executives will take high package for themselves. Okay, because if you don't have anybody monitoring them, if you don't have a committee like this, then in that case, they will have more packages, given to themselves. They'll start paying more to them, more bonus they give to them. Somewhere or the other, the packages that they have to receive, the salary packages, they will keep heavy to themselves. Okay, so that was regarding the topic of corporate governance. I just quickly scanned through the topic only because I wanted you to just get an understanding of the headings once again. So which is a broader framework covered in this particular topic. Okay, then we have the last one which talks about ethics and acceptance, which is very easy to understand. Why do you have professional ethics? Because every professional is carrying a responsibility over him that whatever he does, the profession will get affected. So basically, if you talk about a chartered certified accountant, and if he is actually not practicing well, or if he's not complying with the code of ethics, you say it is a blame to the entire ACCA committee. So because of which the ACCA has come up with the code of ethics, which are compulsory to be followed by the auditors. Okay, otherwise, if one auditor does wrong, then the blame will be to the entire community as a whole, or the entire class of auditors as a whole. So because of which we have professional ethics designed, we have a code of ethics in place for the purpose of, having a good professional standard reputation for the credibility in the profession to continue. It talks about the fundamental principles. So there are very important fundamental principles like integrity. Every auditor is required to maintain integrity, objectivity, basically not auditor, every practitioner. Integrity as in he has to be honest and straightforward. Objectivity means basically unbiased. Whatever he has found, that is what he reports. Confidentiality, whatever information he has got, he should not leak it to the outsiders without the permission of the client or required by law. Professional competence, you should be a person who has the competence enough. You understand the, criteria or the way in which the audit is to be performed. Sound knowledge you should have about the procedure that you're performing. And finally, professional behavior. You are carrying on a professional work. There has to be a professional behavior with you. Okay. Then, whenever any audit engagement has been taken, you have to be very careful of any threat to be present. So if independence is getting affected, then you will not be considered to be giving a reliable audit evidence or audit opinion. So because of which it becomes very important that you have to look in for identification of threats, to assess the threat, to apply safeguards if necessary, and either eliminate the threat or you reduce the threat to an acceptable level. If none of these you can do, then you cannot accept the engagement only. So what are the types of threats? You have self-interest threat, where already you could have financial interest. Okay, there could be an outstanding balance or outstanding fees from the client, and the client has not paid the fees. So this year you will go on giving a unmodified opinion because you will get scared. If I give a modified opinion, the client might not pay you only. So there is some kind of interest involved. So that's called a self-interest. Self-review is where you are only preparing the financial statements and you are only doing the audit. So self-review threat is there. Obviously, you're not going to catch your own mistakes. Familiarity threat is where you're going to be associated with a particular client for a very long period of time. So when you're associated with the client for a long period of time, obviously you're going to develop friendly relationship with them. And when you develop friendly relationship with the client, you will start being compromising on your objectivity. So you will be biased towards them. Intimidation is where the client is trying to threaten you. Okay, of maybe they are threatening you that they will remove you, or maybe they will not pay you. Some kind of threat is imposed on the auditor because of the pressure of which he'll compromise his objectivity and he'll give an unmodified opinion. Advocacy is where you're representing the client on certain matters, and those matters you're supposed to review also. Okay, so basically advocacy threat will be present. Okay, then you have the last one, which talks about the engagement letter. Engagement letter, we have ISA 210, which talks about the auditor is required to prepare a particular letter which is considered to be an engagement letter. This engagement letter has to be discussed with the management and TCWG, and only after they accept it, the audit can be started. So basically, engagement letter is going to talk about the nature, scope, objective of the audit assignment or any of the assignment or the engagement which is going to be proposed to be taken up by the auditor. Only when management and TCWG agree with the terms what are given in this particular engagement, only then we go on for the taking up of the audit. Otherwise, it is not done. So this will include the kind of the audit, the nature, the objective, the reporting timeline, or what is the responsibility of the auditor, what is the responsibility of the management, what is the fees to be charged, okay, the reporting timeline, everything, or what is the scope of the auditor's work. Okay, everything will be given in the part of the engagement letter, which has to be accepted by the TCWG. Only then the audit can be started. Usually, in the case of new audits, we'll have to draft a new engagement letter. But in the case of recurring audit, that means you are continuing to do the audit of the same client in the next year also, then in that case, you will not be required to every time come up with a new engagement letter. Same engagement letter can be given to the client again. But there are some situations where you need to revise the engagement letter. Like there could be change in the senior management, or there could be there have been a miscommunication in the earlier letter, or there could be a change in the real terms and conditions, or maybe the terms of engagements have been changed, the fees that you're charging is changing. Okay, the scope of the audit has increased. The applicable financial reporting framework has undergone a change. So there could be a lot of things which have been changed compared to the previous year. So because of this, in the case of recurring audit, you will not keep the same engagement letter. Rather, you will revise the engagement letter, and the revised engagement letter, only if that is accepted by the TCWG, then you begin with the audit. All right. Also, very important thing, you should be very careful that after the engagement has been accepted, even after that, if the management is trying to limit your scope of your engagement, that means they don't give you access to some of the areas, then in that case, you have to think about either leaving the audit, that is withdraw from the engagement, or you can end up giving a disclaimer of opinion. All right. So these are all the basic understanding regarding the topic of ethics and acceptance. Okay. I have very quickly, in fact, I've just rushed through all these topics only because these topics, anytime you do, reading only has to happen correctly. Okay. Because from your, basically this particular topic, you have the objective type of questions being tested here. Okay. Only from ethics and acceptance where you have the threats and the safeguard to the threat where you can have a descriptive question. Otherwise, more likely you will have section 8 type of questions coming from audit framework and regulation. So because of that, I would always recommend that these particular topics have a very good reading, so that you'll be able to pick up the objective type of questions properly. All right. So I've taken very quickly through all these topics. As I told you, we have done through the topics of introduction of assurance, where we discussed basically about assurance, that is reasonable and limited. and we understood the need for external audit. Why external audit? What is the benefit of external audit? And all the standards and all that we study, they're only for the external audit. Limited assurance is for the limited purpose. It is done voluntarily, not required by law, but for the objective to be served by the directors, they will appoint the auditors, which will perform a limited review, and they give a report which is having a negative assurance. Rules and regulations, what is covered for your syllabus is only the general principles that have been accepted throughout the world. So they have given you kind of a principle that has been acceptable. So for the basic, just to keep you in line, they've taken the UK principles so that you understand the kind of principles that have been accepted. Corporate governance is where people managing the company are different from that of the stakeholders. So because of that, there should not be unnecessary, unwanted utilization or manipulation of the accounts and all happening at the management's point of view. So there has to be a transparency, because of which you have some kind of rules to be followed as a part of corporate governance. Finally, ethics and acceptance is talking about professional ethics, which every auditor is required to follow, about the integrity, objectivity, confidentiality, etc. And also you have to see very carefully whenever you take up an audit, whether there is any kind of independent threat which is present. If threat is there, you have to take the measures for safeguard. And if safeguard is also not possible, you do not take up the engagement. Threats could be self-interest, self-review, familiarity, then you have intimidation, and then you have the advocacy threats. So based on the situation given to you, you have to identify what kind of threat is there. Based on that, try to apply the safeguards. If you can bring it to an acceptable lower level, you can then take up the engagement. Otherwise, it is an ideal option to eliminate yourself from the audit engagement. Is it understandable? So this is the overall discussion of all these basic topics which are covered as a part of the fundamental or the audit framework and regulation. Okay. Now we have the most important discussion that we are going to take up, and that is going to be with regard to the questions that we are going to pick up from the exam kit. Okay. So let us have an understanding. We will take section A type of questions where we are going to have the MCQ kind of question. Okay. So MCQ based questions. So we'll take up 2-3 questions so that you understand properly what kind of questions could be drafted in this particular topic. Okay. So let's get started. So as you know, these questions all will be having 5 questions under them. Each question will be 2 marks. So basically it is going to be a 10 marker question. Okay. So let us get started. So here the following scenario. The following scenario relates to the questions 1 to 5. Okay. The board of directors of sister company are concerned that they are not currently applying best practices in terms of corporate governance and are seeking to make improvement. So basically they believe that they don't have best practices, and now they want to make improvements. What best practices in the case of corporate governance? So maybe they're lacking with the internal audit department, or the audit committee is not that well composed, or they don't have the audit committee. There could be some problem. The company currently has 3 non-executive directors on the board, which is a good thing, who are paid a fee which changes annually depending on the company's performance. Here, NED's fees are based on company's performance. How can that be possible? The NEDs all sit on the audit, nomination and remuneration committee. That's quite good because we require independent directors to be as a part of these committees, subcommittees of the board. There is currently no reference to the work of these committees in the annual report. Wrong. In the annual report, you have to give clearly the work of these particular people. The following is the current proposed structure for the internal audit department. So they are going to decide to come up with an internal audit department. So they have decided to have the finance director on the top. You have a head of the internal audit department. There is going to be internal audit manager. Under him, there is going to be audit assistants. That is the hierarchy that they have planned for the new department that they are proposing. The only role that is still to be filled up is the head of the internal audit. So all audit assistants and all of these they are filled up. But what they could not fill up is the above the internal audit manager, that is the head of the internal audit. There are 2 potential candidates. One is Paul Belling. He is a consultant who helped design the implementation of the company's control system. Quite understandable if you are a part of the control system planning or designing, how you are going to be the part of the internal audit department. How are you going to review your own work which you have done? And Maria Marquis, who is currently an audit manager at Rosie and Bell, an audit firm, which has never been used by sister company. So it's completely an independent source here. Okay, then. Out of the other 3 members of the proposed IA department, 2 of them have moved from the other department in sister company, and one of the audit assistant has an audit experience. So that's quite good. Okay. Now, let us see at the type of questions that you have here. Which of the following should be included in the annual report regarding the work of the audit committee? Okay, just now we had a discussion regarding in the case of corporate governance, where we spoke that in the case of audit committee in the case of annual report, there are some matters that you have to write about the audit committee. Okay, like we are going to talk about with regard to whether you have an internal audit department, and if not, how did you come out with it? Okay, then about any deficiencies which have been identified or explanations for the deficiencies identified with regard to any matter. Okay, then regarding any significant matters which came across during the course of audit or in the financial statement, how did they address? All of that you are going to give it, or maybe if the directors had a threat to independence, how they safeguarded it. Okay, so all of these things audit committee has to report. So here we need to find out, sorry, in the annual report about the audit committee you need to have. So if you look at it, let us see responsibility for preparing the annual report and financial statement. This is not audit committee's responsibility, it is director's responsibility. Obviously, it comes in the annual report, but it is director who will write. It is director's responsibility in the annual report. Significant issues considered relating to financial statement. Obviously, correct. Audit committee's reporting will have significant issues. Then description of the principal risk of that the company faces. Board of directors will talk about it. The process used to make appointments to the board, nomination and remuneration committee. So these all also will come as a part of the annual return, but they will come as a part of the audit committee, directors, board of directors, and NRC. Here, out of the 4 options available, audit committee's point of view that will come in the annual report is going to be only this particular matter. Okay, so the answer will be B. All right, then moving on to the next one. Which of the following option correctly describes the deficiency relating to NED's remuneration and makes a valid recommendation? So quickly, what they have told here, NED's remuneration is based on what? Annual performance of the company. So they are going to get, as and when the company grows, their salary also will grow. Now tell me, in the day-to-day activities, is NED going to perform or executives will perform? Executives will perform. So if you see, if I give executives based on the net profit as a percentage of net profit and all, acceptable. NEDs will never get as a part of the performance. NEDs will get only for the purpose of attending the board meeting. They will get sitting fees which are confirmed with respect to the time that they're devoting. So they attend the 4 meetings, four times they have come. Based on the 4 meetings, we are going to give them per meeting. Got it? So here let us see. First of all, deficiency is going to be compromising NED's independence, correct? NED should be remunerated on the same basis as that of executive team, wrong. Executive team will be based on the performance you can give them. Compromises the motivation of NED? No, motivation will be more because they are getting based on profits. Then compromise again, NED's independence is getting compromised. But here let us look at the reason. NED's remuneration should be set as an amount based on the time committed. This is correct. So basically NEDs only get what? Sitting fees, and sitting fees will be per meeting. So it should be based on the time committed. So obviously this option will not be there. The option will be C again. So earlier the option was B. Now the option is C. The board is in the final stage of establishing the IA department. So they had proposal. So now they're finalizing it. Select one option from each of the column which provides appropriate recommendation to improve the effectiveness and the independence of the IA department. A very easy question. Okay. They have to report to whom? Now, when do you call an audit? When do you call that IA department will be more effective? When they inform the finance director? No. Chief executive also no. These people will manipulate everything. So the independent people will be where? Audit committee. So it is directly responsible to inform whom? Audit committee. Then only it will be more independent and more effective. Who should be the head of IA? See, when we read the question, Paul Belling is the person who has actually designed the control. How can he review the control? So obviously what the answer will be. Maria, who is completely disassociated. She's somebody new altogether. So she will be the ideal person to head the internal audit department. Remaining staff members, appoint more senior staff with audit experience. No changes needed. All staff should be new. No. No changes needed. No, you require to appoint more people who have good audit experience. Okay. So here it will be audit committee. Here will be Maria. Here is going to be more staff. 4th question. The board has started to compile a list of tasks for the IA department to carry out once it is up and running. So IA department, assume it is formed. Okay. So we have already studied as a part of internal audit topic. The internal auditors can take the assignments like the financial audit, operational audit, value for money audit, correct? Now they've given you a situation, you have to identify what kind of assignment is that. It has been agreed that the first assignment to be completed will be for the internal auditors to review sister groups processes over capital expenditure to verify right items are purchased at the appropriate time and competitive price. So don't you think this is about maintaining economy? Should be in the right direction, effectiveness, and also it should be what? Efficient. So appropriate is efficient, competitive is economy, and right time is what? Effective. Correct? So this is nothing but value for money audit. Clear? Then 5th question. So if you can see, if a general understanding also you have, you'll be able to understand the objective type of questions. When deciding on the role of internal audit department in undertaking operational audit, Which two of the following should the team not be involved in? Operational audit is what? That the internal auditors are going to check whether operations are working effectively and efficiently or not. So which should not be involved? Observe the procedure carried out by the sisters, company staff. Observation, yes, you'll do the observation. Reperformance of the procedures documented in the procedure manual. So whatever they have written, whether really implemented or not, that also you will check. So this you will do. Design and implement internal control procedures to address efficiency. And never the internal audit department will do the designing. They will recommend, but they will not design. Then reporting the findings to the board of directors, that also you will do. Authorizing transaction and performing reconciliation. Authorization is also designing only. So which two you will not do is the designing and authorization part. So these two parts will not be included as a part of your operational audit. Remaining all you will definitely do. Observation, reperformance, reporting to the BOD for deficiency, all of that you are going to check. So basically this question was a mixture of the corporate governance and also with regard to the internal audit. More they focused on internal audit. Okay, you'll be able to answer this quite easily. Now let us take up the next question. The following scenario relates to the question 6 to 10. You are an audit manager in Bark & Company and have been assigned to the audit of Foliage Company for the first time this year. Foliage Company is a listed company which specializes in the manufacturing musical instruments. You will be taking over from Kim Bond, the audit manager who has been in charge of the audit for the last 3 years. So we have taken a new audit. So we are who? Bark & Company. The retiring auditors are Kim Bond. Kim has just announced that he is leaving Bark & Company to join Foliage Company as a financial controller. One second, you are the audit manager in Bark & Company and have assigned the audit of Foliage Company for the first time. Okay, you have been appointed. Okay, Foliage Company is a listed company and specializes in musical instruments. You will be taking, okay, Kim Bond is the person who was the earlier engagement partner. Okay, the firm is remaining same, it is still the Bark & Company only is going to do the audit of Foliage, but now the engagement partner is going to be whom? You. Okay. The audit manager who has been in charge of the audit for the last 3 years, Kim has just announced that he is leaving Bark & Company to join Foliage. Okay. So he's leaving that audit firm, is joining the company where you're going to do the audit. And he's going to be as a part of financial controller. Kim has recently completed the planning for the current year audit in the preparation for the final audit, which is due to commence the next month. Okay. Jane Leaf has been the audit engagement partner since Foliage Company became the audit client almost 8 years ago. So the engagement partner is Jane Leaf. Audit managers have changed. Audit managers are key partners, okay? The key people who go to the performance of the audit. The on-field who is doing is the key people. As she has completed 7 years as an engagement partner as we discussed, these are the people who actually take up all the engagement planning. They are going to actually have the discussion with the client. They meet the client and all of those. Jane has recently rotated off the audit engagement. The new audit engagement partner, Chang Petiol, has suggested that in order to maintain close relationship with Foliage Company, Jane Leaf should undertake the role of engagement quality control reviewer for this year. So the engagement partner is who? Jane Leaf. But this year there has been a change, and who has been appointed? It is Chang. Okay, the earlier were not engagement partner, they were audit managers. Now the engagement partner is also undergoing a change. The total fee received by Bark & Company from Foliage in respect of all the services provided in the last year amounted to 16% of the firm's total fee. So out of total 100 rupees, if you take, 16 come from where? Foliage. The current year's total fee income for audit, tax and other related services, okay, audit related services expected to be greater than last year. So it is going to be more than 16%. So here audit manager is changing, engagement partner is changing, and about fee also some matters are given. The question is very interesting. Let us have an understanding. What is the most important or appropriate response to the suggestion that Jane Leaf takes on the role of engagement quality control reviewer? Now tell me, the one who has been closely associated with the client since the last 7 years or whatever they're telling regarding Jane Leaf, can the same person be appointed as a quality control reviewer? Don't you think the familiarity threat will be there, or there is going to be a review threat or something like that? Yes. So basically for a minimum period of 2 years at least, okay, if you talk about the safeguard measures, for minimum period of 2 years, Jane Leaf should not be appointed as the quality control reviewer. Basically, he should not be associated only with this particular engagement. So here, Jane Leaf should take the review immediately. Wrong. Jane Leaf could take the review role immediately, but additional safeguards to be taken. Jane Leaf should not serve as an engagement quality control reviewer for at least 2 years. For at least 5 years, sorry. Yeah, quality control reviewer it is. Yeah. Quality control reviewer, you cannot be for a period of 5 years. Resigning not important. Okay. Not required to resign. Then Which of the following is the least appropriate response in relation to fee income received by Bark and Company from foliage? So 16% is the income, okay, that you're going to receive out of total, and instead in the current year it's going to be more also. Bark and Company should assess whether audit and non-audit fees would represent more than 15% of the gross practice income from the 2 consecutive years. If the recurring fees are likely to exceed 15% of the annual practice income this year, they need to resign. Obviously not. If the recurring fees are likely to exceed 15% of the annual practice income this year, additional consideration should be given as to whether taxation and audit related services should be undertaken. No. If the fees do exceed 15%, this should be disclosed to TCWG. This should be disclosed. Okay. Which of the following is the least appropriate response? Least appropriate is resignation. Okay. This obviously you are going to see that whether it is more because to ensure safeguards you have to put or not, and then see what should you take these services or not, and also you have to talk to the TCWG. So least response is going to be resign. Why will you resign? It's a major client of yours. So resignation is something wrong. So least appropriate is going to be obviously resignation is going to be least appropriate. Okay, remaining all somewhere or the other you're going to consider. Now, next one, if you can look in the 7th one, I've done the elimination criteria. Okay, so even I got confused when it looked at some point. So I told you for MCQs, you also have to look into for elimination. One answer really you have to pick up. So if you have a confusion between two parts, you can use the elimination concept. Which action should Kim Bond have taken when possibility of employment with foliage company arose? Kim Bond, okay. So he has taken employment with foliage. Okay, what he should do? Kim should have notified Bark and Company of the potential employment, so he could be removed from the audit team. Absolutely yes. This only. He should be removed from the audit team. You should inform your employer. Kim should have declined the offer. Why will he decline? No, there cannot be any kind of thing which can stop him from working anywhere he wants. Kim should have not applied for the employment with an audit client which has employed. No, you have the complete independence. Kim should have asked for the permission from Bark and Company before applying. Not required. So answer should be he should inform the employer and come out of the relevant engagement team. Okay, so that's quite a correct one. Which ethical threat will be created when Kim Bond commences employment with client, and what action should be taken to manage the threat? Which ethical threat will be created if Kim Bond commences employment? First of all, Kim Bond will be knowing all the people from the audit team. So there is going to be familiarity threat. Most important, the composition of the audit team must be reviewed and changed appropriate. So the answer will be B. There is going to be a familiarity threat. Okay, because he's going to be a financial controller, and because of which obviously the old audit firm he already knows. So there's going to be a lot of threat involved. So familiarity threat is correct. Familiarity threat, option B. Okay, then select whether the following statement describe a rule book approach or a conception. So what is rule book? Rule book is like law is told you have to follow strictly without using any of your understanding. You cannot use your own judgment. That all is not there. Conceptual framework is where they give you only principles, and as and when you require, you can adjust depending upon the situation. Clearly defines laws for the auditor to follow. It's a rule book. Dynamic profession, conceptual framework. A set of guidelines which the auditor uses judgment. Judgment means against conceptual framework. Easy to know what is allowed and what is disallowed. Clearly say what is allowed, what is not allowed. Rule book approach. A very easy question this was, okay. So we have done with the questions, okay. So let us take one more so that we can have a proper coverage of this. You are an audit manager in Mundada and Company, and you are planning the audit of Mulberry Company, which manufactures luxury handbags and other fashion accessories. Mulberry Company has been the audit client of your firm for 4 years. Okay. From a review of the correspondence file, you note that the audit engagement partner and the finance director have known each other socially for many years, and in fact also went on holiday together last summer with their families. Okay. As a result of this friendship, the partner has not yet spoken to the client about the fee for the last year. That is 20%, which is still outstanding. Very good. The financial controller of Mulberry was appointed 2 months ago. Prior to this appointment, the financial controller was the audit senior of Mundada and Company and was a member of the audit team. Okay. So there is clearly familiarity threat here. Employees of Mulberry Company are entitled to purchase handbags at a discount of 40%, and during the planning meeting with the finance director, he offers you and your audit team the same level of staff discount. So he's trying to, indirectly bribe you. The finance director has asked you if your firm will prepare the company's tax return and provides tax advice to minimize the amount of tax payable. Okay. So there's a lot of information given. Select which threat to objectivity is created by the information obtained from the review of correspondence file. If you can look, first thing you got is the partner and the finance director have known each other. Known each other, the very word known only tells it is which threat. Familiarity. 40% of the fee is outstanding. So there is going to be self-interest. Also, there can be intimidation threat. There could be a fear factor that they could replace you, and you not get the money. Correct? So this would be Self-interest, this will be familiarity. Then, which is the most appropriate response to the outstanding fee from Milbury? The auditor should resign. No. Why will you resign? Everywhere they give the answer for resign. Resign is the last resort. The auditor should report the client to ACCA. No. The auditor can continue working for the client, but should ensure that the audit firm's credit control department are informed. Now, where we talk about all this. The auditor's report for this year should not be issued until fees have been received. Correct. This only will talk about independence. Okay. So do not release the audit report unless they have cleared the fees. Which of the following statement is in respect of relationship between new financial controller and the audit firm are true? Financial controller and the audit firm, do they know each other? Very much yes. Because leaving the last 2 months, he was working with that same audit team. So there is going to be familiarity. So obviously the financial manager will know about all the way in which the work is carried out. He'll be knowing about what is the approach, what will be the procedure of the audit team. So he'll be quite aware because he was working with that audit team only. So basically here you can see the audit approach should be revised to ensure procedures and the items to be tested are not predictable. Because this person, the new financial controller, was a part of this audit team. So he will be knowing how the approach will be. And now because he's a part of the management, see that you have a surprise element for him. He should not be prepared of what is the approach. He should not be readily knowing it. The audit team should comprise people who know the audit senior, as this will make the audit no, it will make familiarity threat. The firm must resign, no. The audit senior should be allowed to be financial controller and should resign, no. See, senior should not be allowed to be the financial controller and all that things are not acceptable, okay. You can't stop somebody. Which is the most appropriate response with respect to discount offered by Milbury Company to the audit team? The discount may be accepted as it is the same as it is offered to the client employees, no. The discount should be rejected as it is unlikely to be trivial monetary amount. You have to reject it, okay. The discount should be rejected as gifts or hospitality are not acceptable as per ACCA Code of Ethics. See, gifts and hospitality are acceptable. Okay, only up to a certain limit if they're trivial. Audit manager approval must be obtained before the discount is accepted. True. Not audit manager. You will take the approval of whom? Engagement partner. Why audit manager? So the most appropriate answer would be the discount may be accepted as it is the same as offered to the client. No, you cannot do that. The discount should be rejected as it is unlikely to be trivial. See, it is 40%. And 40% is going to be material amount, and because of which it is not trivial in nature, so you will not accept it. You have to reject it. Yeah, rejection has to happen. Yeah, and gifts and hospitalities can be accepted as per ACCA Code of Ethics if they are trivial in nature. Okay, so this also would not be most appropriate. So the answer here will be discount should be rejected. It is unlikely to be trivial monetary amount. Okay, then select the option which is correctly identifies whether or not a self-review threat is likely to be arising in the case of tax service requested. So tax service 2 are requested. One is preparation of tax return. One is to provide tax advice. See, when you prepare tax return, there is nothing called as your personal judgment involved. Tax return is nothing but whatever client data is there. You have a very clear protocol to be followed. There is a way in which the reporting is done. Okay, you have a mechanical approach. You have to fill the details. Whatever client will give in this particular report. That is tax return. So your auditor judgment is not there. Whatever is information given by the client that you're putting in this particular format. That's it. But tax advice, your judgment will be involved. So obviously review threat will not be on tax return. But review threat will be on tax service because provision for taxation and all. Here obviously these are going to be financial statement things. And obviously if tax provision has to be evaluated, auditor will obviously consider it to be correct only because he has done it for you. So self-review threat will be for advice, but not for tax return. So tax return was first one. So tax return, no. And tax advice, yes. So self-review threat will not be there for return, but will be there for tax advice. Option will be D. Got it? So these are all the kinds of questions that we have seen, which have been come as a part of, this particular chapter, okay, or this particular topic, where we also got questions from corporate governance, from rules and regulations, from ethics, and all of those, where basically threats are, I told you, a very common questions that we come across as a part of these first topics, okay? Okay, just for a proper understanding, okay, so we have basically covered with all the topics that we were supposed to do when we looked into for the sequence of a revision where we discussed it initially. In the first day of the session, I told you the way in which I'll be taking over the topics for you, and we have strictly followed the sequence in which we have done the revision, okay, and if you can see here, we first did the planning and assessment, which we have taken in detail by picking up every single concept. So that is the part we covered. Internal controls we have done in detail. Procedures, we also picked up the question, understood the proper audit approach and the examination importance. Completion and review also we have done in detail, understanding the topic in detail, and also we took a very important question as well. And today we spoke about the framework where we took more of questions than for the basic understanding of the topics because they're purely theoretical. Now, as per the last discussion, we are going to pick up some important questions from the descriptive part. Basically, I'll be focusing now on the section B, where we'll try to take 2-3 exhaustive questions and do a detailed discussion of these questions. Why? Because it becomes very important for you to understand what should be the approach and the way in which these questions have to be answered. Okay. So the last discussion that we are going to have is going to be, we are going to take up the questions for our understanding. Descriptive, we'll focus on the section B because that goes as a difficult part. And as I've taken the first 5 topics, I've taken descriptive kind of, MCQ kind of questions only. So that's a sufficient way in which you understand what the question structures would be and how you're required to analyze it. How sometimes you can also use elimination criteria. All right. So we are now in the last leg, that is the 6th part of the revision, the last part of the revision session, we will focus on the descriptive question, which is going to be very, very important, where we'll take exhaustively 3-4 questions, where we'll do detailed discussion and understand how the answers have to be written in this particular area. All right. So we'll stop the discussion here for today, and we will then take up the section B, that is descriptive questions in detail, where questions we are going to pick from the exam kit, have a proper reading of the question, analyzing of the question, and basically the finalizing, that is interpretation of the question correctly. And then the most important part, how we are required to address, that is write these answers properly. All right. So that will be the complete coverage and properly a coverage for the exam preparation. All right. So we'll stop here for today. We'll continue in the next session. Thank you.